So our next speaker is Lee Williams of Shawbrook Bank. As you can see, just checking for any COVID weight might have been put on. No, he's looking pretty good, actually. Okay, not doing too bad. Still hasn't shaved, unfortunately. But so Lee Williams, you would have received this from us this morning. This is their second. Lee's going to be talking, as I mentioned, about second charges today. And he's just been moved over to that. So be nice to him. He does know his stuff. He's been in the market a long time, but obviously this has been put on him fairly recently, the second charge side. So leave all the really technical questions to me at the end, if you would, and I'll give him a hard time. Everyone said they can hear him, that's fine. Okay, so
at least he won't be able to hear my
a little
answer.
bit about Lee, first of all. He's a regional development manager for Shawbrook, covering East Anglia and Essex. He's been with Shawbrook for 3.5 years, might be a bit more now, actually. And prior to that, he has 30 years experience in financial services, predominantly with high street banks. He looks after 115 brokers in his region, might be a few more now. He's got the second charges on board, helping with second charge loans, regulated, unregulated bridging, buy-to-let commercial and semi-commercial investment mortgages. His speciality is working with brokers to shape large loans to present to their complex deal forum for early stage board approval. Okay, and his interest, in fact, he's a keen snooker player. I don't think he went to school by the sounds of things, so but misspent youth, and has won a couple of amateur tournaments at local club level, and once played against a professional player who I believe was Barry Pinches, if I remember rightly. Not Lee, if that's correct. Good. Okay, well, I still can't hear you. So okay. This is going to be the quietest presentation I've ever seen. I have no idea what's going on. I'll get my IT department in a second. But Lee, it's over to you.
Thank you, Tony. Good morning, everybody, and thanks for inviting me to speak about this. So yeah, as Tony said, I work in commercial property for Shawbrook. So we look after bridging, both regulated and unregulated bridging, semi-commercial and commercial investment mortgages, and also second charge mortgages, which I've just recently started to look after as well. So what I was going to go through today is just an overview of Shawbrook, in case some of you aren't aware of who we are and what we do, and to give you some information around our products on second charges and a case study. So in terms of Shawbrook, we were formed in 2011 and born out of the last financial crash in 2008. So this is our 10-year anniversary, which we're very proud of. We are a specialist UK lending and savings bank focused on property finance, business finance, and also consumer lending and savings. So since our inception, we've lent over £6 billion in originations. We're very much a traditional bank where people are the lifeblood of our business. Can you hear me okay now? Okay, hold on 1 second. Is that better? Can you hear me now? Can anyone hear me now okay?
Lee, I can hear you fine because I worked out that I'd not switched my sound on my laptop. So that was my senior moment of the day, hopefully. I can hear you. You're a lot better now, yeah. So
I've just plugged my earphones in as well, so I think it's better now. So, okay. Right, so as I say, we're very much a traditional bank. We take in savings and deposits and we lend, as I say, and commercial property division is the core really of our business. So our sort of job in commercial property, I'm a regional development manager that looks after the East Anglia and Essex region. So I go as far, based in Norwich, but I go as far as Peterborough, across to Milton Keynes, and then down as far as the M25 and across to Essex. We work very closely with our intermediaries. So I look after about 100 intermediaries now across the UK, and we've formed long-standing relationships over our 10 years. And specialist financial services have very much been an integral part of that over the time. We have specialist expertise in the market, so all of our underwriters are accessible. We've got us as a BDM team that are always able to help with inquiries for our brokers and to help shape deals. And most of all, our criteria is really transparent. It's all on our broker hub. So our brokers can see the same criteria that the underwriters underwrite to, and our fees and our rates are also very transparent as well. And over the 10 years, we've won multiple awards for our products and our service, and some of those are listed across there on the right. So ahead of the curve. So there's an interesting I think you'll find a lot of lenders at the moment are sort of investing in technology, and technology sort of taking over the way that deals are processed. And at Shawbrook, we're no different. We've invested over the last year around about £4 million in our technology, and the fruits of that are starting to come to fruition. However, we very much recognise there needs to be a balance between technology making a journey for a broker and a customer easy, slick, and efficient, but not moving away from the expertise that you have from an underwriting team that have got many years experience. And so we're never going to be a lender that uses credit scoring and a computer says yes or no type approach. And our underwriters very much have the discretion to look at deals on their merit and to make decisions, and sometimes even outside of criteria decisions where it's a good deal and one that we should support. But as part of our progress, we're widening the use of automated valuations, which means that it massively speeds up the process as well as saving customers time and money. We've got a really good product switch proposition on the commercial property side, where people are moving perhaps from bridging onto a term loan if they've done some work to a property to make it mortgageable, and then want to switch it onto a term to keep it at the end. And as I mentioned in my intro, really, we've also got the ability to put deals in front of a complex deal forum who will look at an opportunity at a really early stage, but have the benefit of somebody from group credit there, somebody from our risk division, to really kick the tires and see if it's a deal that we can support, even if it doesn't quite meet our criteria. And with our processes on the Broker Hub, as I say, we're massively sort of investing in that at the minute, but we can go straight to an indicative mortgage offer within 20 minutes. So moving on to charges, which is what I've been invited to talk about today. That's me. That's not me surfing, I hasten to add. Yeah, in terms of our proposition on second charge mortgages, why do specialist financial services work with us on the second charge side? Well, we've got some sort of niches that sort of give us a bit of an edge in the market, and this is why brokers come to us with their deals, really. So we don't have any minimum income requirements. We can consider contractor income, and we've got a competitive in the market criteria on that. Historic credit issues we can consider. So as long as people have been clean for the last 12 months, if there's anything older than that, we can certainly have a look at and see if we can consider. I mentioned the use of automated valuations. So we can use automated valuations on the second charge side, where somebody wants to borrow up to 300,000 at 65% loan to value, or 100,000 up to 75% loan to value, or even 50,000 up to 85% loan to value. So really quick and efficient way of sort of getting the value of the property and proceeding through the application process without having to get a physical valuation done. In terms of employment or self-employment income, if you're self-employed, we only need to see 12 months self-employed. If you're an employee, then 3 months worth of employment, and then you can consider a second charge mortgage. We can consider downsizing as a viable lending into retirement exit strategy, which is a really good option there. Our online system is really user-friendly, and that's backed up really with our support team on the second charge side. So there's a lady called Robin who looks at the applications as they come in, and will pick up the phone to the brokers if there's any questions or queries that she's got in the case before it gets to see the underwriters. Minimum property value of 70,000, so that's helpful for sort of the properties that perhaps don't meet other lenders' minimum loan property values. And loan to income, we can consider up to six times income. As I said, our lending criteria is really transparent, and you should have that in your inbox today. And that really is a good reference point. I'm not suggesting that you need to learn it line by line, but it's a good reference point for those weird and wonderful questions that pop up when you get inquiries on the second charge side. And yeah, I won't be testing you on it, but yeah, it's a good reference point to keep in your inbox. And as I said, there's an expert consultative team. So Specialist Financial Services have got me as their point of contact, but there's also a support team behind me that can help with their inquiries and help with pipeline cases. Some of the purposes that are acceptable for second charge mortgages, and as I have to say, sort of
since lockdown started and people have been locked up in their homes and perhaps now working from home and needing to convert a bedroom into an office or a garage into an office, we're certainly seeing an uplift in these type of scenarios, such as home improvements. Debt consolidation we can consider. It can be for business purposes on a case-by-case basis, not startups, but for investment into their business. That's potentially a use we can consider. Deposits for additional property purchases, be that a second home or a buy-to-let purchase. We see that quite from time to time. Repaying a tax bill. A nice holiday, not that there's many options at the minute, but as things start to open up, people have been locked up for 18 months. People might decide to treat themselves and go on a nice expensive holiday. I know I'm going to be trying to. Medical procedures, with the NHS queues where they are at the minute, people might decide to pay to go private, and again, a second charge might be a way to do that. Car purchases and school fees are okay. Weddings, gifting money to a child to perhaps help them get on the property ladder is acceptable. Anybody wants to gift me some money and adopt me, that's absolutely fine. Transfer of equity and lease extensions, and then repaying Help to Buy, all acceptable reasons to use us for a second charge. This is a case study of a second charge deal we did recently, and it's one of our long-term broker partners who specialise in second charge loans. They had a client who urgently needed a £500,000 loan, and the reason was they had a plot of land next to their current property, and they were concerned that it was going to be purchased for a commercial use, which then would have had an impact on their own property. So because of the time-sensitive nature, they really needed to get the deal over the line as quickly as possible. And because of our relationship with the broker, we were able to sort of iron out any queries that they had and get the deal over the line in a really speedy manner. And that really enforces the fact that brokers can speak directly to the underwriters rather than emails back and forth and things going around the system for days on end when a quick phone call would have just solved the query. So despite an unusual issue that cropped up on the application at Land Registry, we managed to fund the case within 7 working days of submission. And 500,000 for us is a really big second charge loan size. So we were really delighted to get that over the line within 7 days, as was the customer. So the terms on that was 4.2% up to 65% loan to value. And as I say, the customer was delighted and certainly helped save the value of their property or increase it. In terms of our product details, we can lend up to 85% of loan to value of the property value, less the existing mortgage that's outstanding. We don't charge any early repayment charges, and we have no charges for making overpayments during the term. And as I said, we can consider some credit issues historically, or people that have got unconventional income. Rates start at 4.2% variable, lending amounts from 5,000 up to 500,000. And as I said, repayment periods, anything between 3 and 30 years. This is my contact details. As I know the contact details for Specialist Financial Services are where you'd go to with all your inquiries. But always happy to have a chat and talk through a scenario. And then obviously you can go back through to Specialist Financial Services to process the deal for you. My email address, my telephone number is there. And that's my pre-COVID photo. Not sure if I can fit in that suit anymore. Thank you, Tony. Over to you to see if anyone's got any questions. Oh, I forgot to move the slides on, didn't I? Sorry. There we go. Case study back up and the product details there. Sorry, Tony.
I'll come back on. Do you want to go through your case studies or?
Yeah, I did go through the case study.
Oh, you did? Oh, okay, sorry. It might have been, yeah, sorry, everybody, but earlier on, I didn't actually have my sound turned on my laptop.
Oh, that was my fault.
I
didn't move on the last few slides, but the product information is there. And then the contact details for you guys at Specialist Financial Services is there.
Okay, right. So basically, pretty much, we've been with Shawbrook since they first launched. One of the first brokers they approached, because we was one of the few brokers still left in second charges, all the way back in, I think it was 2011, wasn't it?
Yeah.
But prior to that, they were actually trading under another name for a little while. So I think it was about 6 months they were trading under a different name and then rebranded as Shawbrook. But in that time, give an example of how flexible they can be. I can remember two deals in particular that I remember. One was for one of the largest importers of cheese into the UK, who was looking to repay, I think it was in the region of about 300 grand's worth of unsecured debt that he'd been using to basically fund his business because his bank withdrew all support completely. So we helped him to do that. That was a very nice deal. The guy actually delivered for my 50th birthday a crate of cheese to my house because he knew I was having a party. But unfortunately, he delivered a gorgonzola that weighed about 5 kilos, and I was giving it away to people as they walking past my house, pretty much. But the other one we did was probably the better of the two, was for a property over in Berkshire. That was it was basically a big country pile, but they bred horses, so it had this huge amount of land with it. And they had all the thing that goes with raising horses. Normally, lenders wouldn't touch that type of security. But I spoke with the then managing director, Philip, and said to him, look, this is the deal. It's a great deal, great income, great everything else. Property is obviously unusual, and he went out and saw the property. Liked it, liked what he saw, completed the deal next day. So again, just sometimes they're very, very approachable, very knowledgeable in what they do. And at the moment, really are coming up to like the top of the league table, sort of like the sourcing system that we have, certainly, when it comes to placing cases. So I will be covering later on about how the cases can be submitted, because Shawbrook don't tend to go out to the entire market. I know they've got some things with Simply Biz and other bits and pieces where you can place cases, but unfortunately, Simply Biz and Legal and General got no idea on second charges whatsoever. Seriously, if you have tried them, you'll probably back me up on that, because I've actually spoken to them on second charges. I haven't got a clue what they're talking about. We've been doing second charge. My longest serving member of staff in second charges joined me in 1997. So next year she gets her clock, apparently. So we do tend to get that a lot of business through that probably you wouldn't be able to get through. But also we've got a system I'll cover later on where you can package and we don't charge any packager fees. So on to the questions. I think there is actually is there a question bit there? I can't, maybe there isn't. Okay. So has anyone got any questions for Lee? Hi, Lee. This is Amanda. Hi, Amanda. I would like some info on the seamless bridge to term process. Who would I be best to speak to?
Well, that would be me. So yeah, is that something I can perhaps speak to Amanda about afterwards?
You can do. Amanda, I don't know your surname, unfortunately. I think we might have two Amandas on today. So if you could just let us know what your surname is. Then I can put Lee in touch with you.
Lovely.
I think it's coming up now. There you go, Doherty. Okay, I hope I pronounced that right. So, okay, I've got a couple of questions that Lee has produced earlier on. So, okay, so Lee, can overtime and commission be included in income assessment?
Thanks, Tony. Yeah, we've just recently enhanced our sort of criteria on income. So yeah, we can now fully consider overtime and commission at 100%, which is a really positive move, I think.
That's great. Second one, can quarterly and annual bonuses be included?
Yeah, again, as part of the recent changes, we can consider those. 50% of the annual, quarterly, or monthly bonuses can be considered. So yeah, it's another positive move. And
just to remind me, I think it was covered in your presentation. What's the maximum LTV you're currently going to?
85%.
85, okay, which is fairly standard in the marketplace. Anything above that, then it starts getting into silly season on interest rates, unfortunately. I am hoping that lenders will start to extend that at some stage, because most of our second charge lenders are running books of clients that they've got pretty much zero arrears.
Yeah.
So in my opinion, they're not taking enough risk. But yeah, the LTVs, I think we do need to see some lenders fairly soon going to higher LTVs. But the main thing on second charges, of course, is the income multiple. You know, if any of you that are in remortgages know some of the problems you have sometimes, pretty much 4.5 times, sometimes less, sometimes a bit more if a lender's actually got any sort of like capacity for anything above that. But 6 times income with no ERCs. So if you've got somebody maybe was suffering during COVID on income, for example, and you can't get them away on a remortgage, or the situation is they're currently on a fixed rate. How many 5-year fixed rates have you written in recent times? What are those borrowers going to do if they need to borrow more money and if they can't get a further advance? Well, a second charge is a very, very good option, and rates are as cheap as they've ever been. When I looked at my first brokerage, I mentioned earlier on, 1989, we had 2 rates, 22.6% and 25.6%, and then a lender came out with a 100% LTV product at 29.7. So things have changed slightly. They're currently offering rates. I think, is it rates under 4%?
I think we're at 4.2.
4.2. Okay,
yeah.
so it's as cheap as it's ever been. So we have brokers who write a lot of business on second charges with us, purely because they see it as helping their clients out in the meantime, remortgaging in 3-4 years' time when their fixed rate ends. And of course, you've also got those clients who borrowed before 2008 who are still, like myself, sitting on a stupidly cheap deal. I'm paying 0.6 over base for life on my mortgage. And I'm certainly not going to would never remortgage that. I can't get a second charge, unfortunately, because it's a conflict of interest. But luckily, I don't need to borrow. We haven't got any more questions, Lee, and you finished way ahead of time. So we've gained about 8 minutes, which is always great. So unless anyone's got anything else they want to ask, give it 10 seconds or so. No, nothing coming up. There's nothing. It's not saying anyone's typing anything. So Lee, thank you very much for the presentation.
You're welcome.
Great as always. And you go off down the snooker hall now, I presume. Or practicing. Hit Barry Pinches back, see if you can beat him.
Yeah.
Okay. Right.
Thanks, guys.
Thanks. Cheers, Lee.
Cheers. Bye-bye.
So next speaker is Simon Michael from Alternative Bridging Corporation. Just again looking to see no COVID weight, but there's probably a good reason behind that. Simon hasn't put on any COVID weight. I only mentioned that because I put on a stone and a half over COVID, and I can't
I think we all have.
So you should have received this. There was 2 of you. I'm just checking no one else has actually registered. There's 2 of you that registered after 10 o'clock when I first started speaking. So Nigel and Philip, if you check your inbox, you should have all the lender terms because I emailed you a short while ago. If you haven't got them, then let us know, and we'll get them out to you again. So you should have received this, and this was the one, unfortunately, that this morning we found was 43 megabytes in size. This particular document, so we had to squeeze it down a bit. So you should be able to open it. I think it's down to about 2 meg now. So okay, so a little bit about Simon. We've known Simon a long time, by the way. They're very local to us. Got a great relationship with them. Simon is 44 years old and has been married for 3.5 years and has a 2-year-old with another one on the way. Congratulations, Simon. See what you were doing through COVID. He's been in the financial service industry since 2002. He was a mortgage broker for 15 years and has now been with Alternative Bridging as a BDM for 4.5 years. He likes to stay healthy and does lots of cycling, hence no weight gain, both off-road and road. And his diet is mostly plant-based. There you go. It's making me feel hungry, actually. Interesting fact, Simon speaks 3 languages, English, Greek, and Hungarian, just about. I'm not sure if the just about is Hungarian, Greek, or English, Simon. Which one is it?
It's the Hungarian because of the wife.
Okay.
Yeah.
Now, on special request, Simon will do his presentation today in Greek, if you so wish. Not Hungarian, because he's not particularly good. He's not very good at it, apparently. But he's open to requests. So, but now you will be obviously doing it in English. Over to you, Simon. I think the next slide is yours. So I'll see you in about 20 minutes.
Thank you very much, Tony, and thanks for inviting me onto this chat today. So yeah, I'm the BDM for Alternative Bridging, and let's get down to the next part where we need to be. There we go, and I'll tell you a little bit about us. For me, you will see on here. So I started as a mortgage broker in 2002, having come from IT recruitment. I had worked for a variety of mortgage firms, got into commercial banking, came back into mortgage broking, and then decided that what I really wanted to do was be a BDM, not be a broker anymore. ABC gave me the chance in early 2017. I've been there ever since. So yeah, over 19 years in the property finance industry. So yeah, absolutely there. That's all good. Now, for some reason, is that? Get on to the next slide. No, so I'm having a bit of a technical issue here in that I can't go to the next slide. Oh, there we go. It's all right, sorted it. Don't worry.
So any problems, just let me know. And I'll give you a hand up. I'll act as your less than glamorous assistant. All right.
Absolutely.
So just let me know if you need me.
No, it's all sorted. Thank you. Okay. Right. So Alternative Bridging is a company that actually started in 1993 under the name of Southern Funding. But they were doing kind of broking and lending at that time. Then they got into more lending. And then in 2008, the brand of Alternative Bridging was born. And as you can see, generally the company has had over 30 years in finance. But the directors themselves have been in the property game for a lot longer than that, with our chairman, Brian Rubens, now being 82 years old with a brain sharper than most of us here. And so what we have I think what our main USP is across, there's lots of bridging lenders on the market. There's loads actually, in excess of 80. And a lot of them offer the same thing. There's a few that stand out and, have very individual products. Our sort of main USP point is the fact that we have one of the widest range of products. And you'll see as I'm going to go through them all now with you, in that we can kind of be like a one-stop shop. So if a deal was brought to us, there'll be one way we could make it fit depending on, what it is or what the client needs. There's a way it can be done. But let me start by just telling you briefly about our products, starting with residential bridging. So on here, it does say interest rates from 0.65 per month, but as of literally a couple of days ago, not soon enough for us to change this presentation, those rates are now starting from 0.6 for residential properties. But the loans for a 0.6 rate has got to be over, over about 300,000 for us to want to do that. So on residential properties, we go up to 70% for non-reg and regulated. You'll see that the two differences on there. Regulated has a maximum of 12 months. Where we say about properties being remote locations, to answer the question on there, something that is sort of like a far drive from any major city or major amenities, with very poor access roads to the property, in an area where there's low demand for property, like say it's maybe a very remote village in the middle of Wales, for example, or some of the places around in England where they're just very far without an attractive property proposition. So it's hard to give a specific on remote location, but it's a case of let's have a look at the deal, let's have a look at where it is on even on the map and the local areas, and then we kind of decide from there. We do look at adverse credit on both non-regulated and regulated loans. There has to be obviously a reason, a good story behind the regulated, the adverse situation. And if it's a believable story, then we can consider it. The only thing to note with regulated bridging is all of their adverse credit has to be cleared with our bridge or with their own cash. We can't enter into a bridge with these clients with outstanding adverse credit. And on both of these types of loans, first and second charges are available. Moving on to commercial bridging. Now, in the bridging world, commercial bridging means commercial properties. So we're talking, as we see here, commercial investments, retail units, office building, industrial premises, residential investments. Here we're talking about HMOs and things like that. Now, on commercial properties, we can go up to 70% loan to value with rates from 0.75. Now, we think that's quite strong in the industry where many are going up to 65%. We would ordinarily be at 65% loan to value. But if we have a commercial property that's tenanted with at least a longer lease on there than the length of our loan, we can go to 70% loan to value on those. Same as the other ones, adverse credit considered, as long as the story behind it is believable. Now, on commercial, it's probably more important to tell you about the types of properties we don't lend against, which is listed here on this screen, which is pubs, bars, cinemas, clubs, gyms, bowling alleys, golf clubs, football clubs, things like that. With one exception, is to say that if any of these particular securities were part of a wider portfolio and we didn't need to rely on one of these securities to get our money back, then we could include those and lend against them. We don't lend against farmlands, livestock, or land with agricultural ties. We don't lend against operating care homes and filling stations, and vacant office blocks with no agreed tenancy. Having said that, we are starting to look at some vacant office blocks with a maximum loan to value of maybe 45 or 50% loan to value if it's in a good area. Moving on to development finance. Now, we've always done development finance. It's one of the the main products we do, and I would say that 40% of our loan book is development finance. And On the left, you've got our standard product, which goes up to 65% of GDV and rates from 0.9 per month. But what I'll tell you now is about our new product, which is called Development 90. This was released in February of this year, so it's been running for about 6 months now. It's a stretched senior development product. So it goes up to 75% of GDV and 90% loan to cost. As far as we're aware, there is no other development lender that is providing the combination of 75 of GDV and 90 loan to cost. 90 loan to cost effectively means if you have all of your construction costs, all of your purchase costs and everything all rolled into one, plus the bank interest, the client is putting in around 10% of their own cash into those costs. So to qualify for this kind of product, the client would have to have done at least 3 developments, similar developments to the one that is looking to us to fund. And we need to see proof of that. Also, we have a maximum unit price of £600,000 per unit. So we can't provide this product if the houses that are being built are worth £1 million and there's going to be, say, 4 houses at £1 million each. It wouldn't qualify for the Development 90. On this, the rates are a little bit higher. They're 1% a month. The exit fee is a little bit higher, 2% a month. So they're paying an extra, however much extra they're paying, between 0.9 and 1. Say over a year, an extra 2% in the cost, but they're getting an extra 10% in the GDV. So, you know, if you've got a £3 million GDV, that's an extra £300,000 into the loan. So it's a very good product, difficult to get hold of because there's a lot of qualification points to hit. But if you've got very experienced developers who have got a number of projects going on and can't put a load of money into a particular deal, this may work for them. And again, happy to answer any specific questions as we go forwards. Flexible overdraft is one of my favorite products, actually. We've been running it for, I think, 2.5 years now, or maybe even 3 years. It's a revolving credit facility. So it's like a bridge against a property, a residential property, commercial property, but the funds can be drawn, repaid back, redrawn again, over and over again as a flexible loan product. There's only one set of charges, which is the initial valuation and legal fees and whatever due diligence is done against the property's first time out. Over the next 24 months, there's no additional charges for any further drawdowns or paybacks and drawn again. The facility can even be extended after 2 years. And also we can add additional security and increase the loan. So let's say you use the facility to buy some properties and want to add them into the facility, we can do that as well. We can go up to, well, it says there's 65%. We can go to 70% on residential properties on the overdraft facility, though we do have a minimum loan of 250 and a max of 3 million. So we can't do the really, really big loans on this product. This can be done for, well, there's kind of like 3 main ways that people would need revolving finance. The first is for auction purchases. A property purchase, being able to be a cash buyer or have a quick deposit to be able to put down to secure a property. Another one is for drawing funds against an existing property you've got to build another property or inject funds into a development without having to borrow money from a development lender and jumping through all the hoops of getting that done. Or another way we've been doing them is for companies that want some cash flow. So rather than going to asset lenders who might provide like a cash flow facility for a business and rates of 1.5 or 2% per month. On here we're talking about rates from 0.8, 0.85 a month, but secured. You're not talking about unsecured, but can be used for working capital for a company, business cash flow, business expansion. To be honest, this product can be used for anything, any legal reason. Even if you want to go and buy a boat, for example, there's no issues because we have the security, we're lending the money against a security property. So that is one of my favorite products. We now have a new product called the refurbishment loan. Now, over the years, We've always done refurbishments one way or another, so but we've never had a specific product for it. So this has now come out. This is been out for about 6 weeks now, 7 weeks. It goes to 70% of GDV for any kind of refurbishment project is being done. There'll be an end value. We can lend up to that end value up to 70%. We have 2 products. We have light refurbishment and heavy refurbishment. The light refurb would be for works that don't need planning permission. So it could be interior refurbishments, as it says here, various repairs, decoration, installation of bathrooms, kitchens, staircases, things that aren't having any structural effects or structural changes to a property, and again, that don't need planning permission. For that, we have a rate of from 0.75 per month, which will reduce to 0.65% at practical completion. So when the property has practical completion sign off that it is ready, the rate will reduce to 0.65 while the exit is being achieved, i.e. a refinance or sale or whatever like that. Now, under the same banner of this refurbishment product, we've got a heavy refurb product with supervision, as it says there, so i.e. monitoring will be done. This is for works that need planning permission. So it could be structural reconfiguration, extensions, even changing of planning use and converting from offices to residential, for example. On this, we have a slightly higher rate of 0.85 per month and still reverting to 0.65 at practical completion, but there will be an exit fee of that of 1%. But this is a great product. It's very exciting. I think overall, with the fact that the rate reduces to 0.65, makes it one of possibly the leading refurbishment products out there on the market. So I'm quite happy to be able to offer that to everyone. On to the next product. Well, products are finished. So as you see, we've got a very wide range. Let's now talk about proc fees. So we've always paid proc fees. Typically, we pay 1% of the loan. But in the past, we have paid 1.5%, we have paid 2%. We've even paid 0.75 for a broker that wanted to take a lower fee and we take more. What we can do is if we increase the amount that we earn on a deal, we can reduce our rate. If we're reducing the amount we earn on a deal, we can increase the proc fee to the broker. So let's say, I'll give you an example. Say we offer a rate of 0.7, paying 1%. If the broker wanted to earn 1.5, we can increase the rate to 0.75 per month, an extra 5 points. So we can flex that up or down depending on what's needed. Additional broker fees can be added to the loan as well. And as it says, there are higher proc fees possible. So when we have relationships with brokers who are giving us regular business, we can arrange for higher proc fees. And what we do, as long as a deal completes by 3 or 4 o'clock in any afternoon and we have the broker's invoice, the money is paid straight away. We pay all of our broker fees same day or next morning. Sometimes deals complete at 5 o'clock in the evening, but we do that. And also, if we rewrite a loan, in a year or 2 years' time, we arrange, we give a little bit to the broker as well, but we discuss that with the broker at the time, whether we, in terms of what can be done. But either way, we do pay out, and Tony will attest to that we do pay immediately on those. So why use us? Well, as I said before, we've been established over 25 years. With the directors involved and all their time spent in lending, we have over 150 years of lending experience. We even have our directors on hand, and they're contactable by arrangement to resolve any issues. We've got a strong background in property and lending against property, and we pretty much know any of the types of problems that can arise. And the main thing is, if there's a deal that we want to do, we will find a way to do it. We'll take views on things, we'll take indemnities on things. As long as we are keen to do the deal and get the money out, we'll find a way to do it. Every deal has a specific underwriter assigned to the case, and they are always on hand to speak to the broker and the client if required. We only offer to lend on a deal when we have certainty that we can fund it. That's one thing that we stand by from, and we can move quickly. If everyone has the right motivation and the client solicitors can move super quick, well, we've completed deals in 5 working days, in 8 working days, in 14 working days. It can be done, but inevitably, in the current times that we're in, with the way the solicitors are working, I'd say the average time for a bridge is anything from 3 to 4 weeks, although we have done them in under 2 weeks. So future-wise for ABC, we're bringing in, well, you've seen the product suite. We've got new products already. They are looking at other ones as well. We're looking to evolve and refine the products to make our proposition more appealing to the brokers. We're bringing in new technology, and we're using e-sign ID verification online. We've brought in the Nevo app, which allows our clients to upload their passports and ID via the app, and then we don't have to go and meet them and get copies of passports and things like that. And likewise, we don't have to go into the solicitors and do that. Looking to improve and add to our team, we have already employed 2 additional underwriters, 3 additional case managers, a new BDM, and we're looking at bringing in a further BDM as well for the Southwest. So we have been improving over the last few months. Funding lines is something that we're always keen to explore. We've recently brought in a new development funding line, which has allowed us to do the Development 90 product, and generally bringing in cheaper money, which allows us to reduce the rates, as we have done now with our headline bridging rate starting from 0.6. And the new website is nearly done. They are working on it. It'll be a much slicker affair than what we've had in there for the last 4 or 5 years. So that has brought me to the end of the presentation. I can open the floor up for questions. Tony will have questions that I set earlier as well.
I hope you know the answers.
Yeah.
Okay, Simon, so you got your first, this was asked actually quite early on. Bill Curtin, hi Bill, hope you're well, has asked a question. Can you classify a remote location, please?
So as I alluded to, it's kind of something like an area which has got fields all around it. It's got a single track road to get to the property. It's a single property, and there's not another property for like maybe half a mile. It takes half an hour to get to any kind of near town with amenities, unless the property is kind of a special type of house. But kind of, I would say that if that sort of thing was anywhere within the southeast, it's fine. Once you start going out into the true countryside, then it's really a deal by deal basis. It's hard to say that a particular place is classed as remote. It's more about seeing the deal as a whole and then going from there.
Okay, so no sheds halfway up Snowdonia then, in that case.
Something
okay,
like that, yeah.
Someone is typing, but I'll ask one of the questions you said. What is your current lending appetite?
Strong. Like I said, we've brought in new funding lines. We've got money to lend. We want to get money out the door. So it's a case of getting the deals in. We're approving it. I think since Monday, I've had 5 deals in, of which all of which we've offered terms on. So we are keen to lend on nearly everything we're seeing. And the good thing is, at the moment, everything we're seeing that's coming in is of a kind of a higher quality than the usual, where we see loads and loads of deals and can only pick and choose what we can lend on. So I'd say our appetite at the moment is very strong. Okay.
One of the questions you set yourself, you've actually already answered in the presentation, but just as a reminder, what's the difference in pricing on your light and heavy refurb product?
So that's good to bring it up again. I think that's why I put it in there. So the light refurb is 0.75 a month, reducing to 0.65 at practical completion. Heavy refurb is 0.85, reducing to 0.65 at practical completion. Practical completion, for those who don't know what that is, that's kind of the point where the house is finished. It's ready to move into, but there's a few things, maybe a few doors need adjusting, maybe some other bits need sorting on it or things like that. Minor points. So when the house is practically complete, that's the point at which the rate will change.
Okay, Philip Game has asked the question, the flexible overdraft, can that be secured on a residential property and the new purchase, or is it just on existing property?
The answer is yes. So we can, let's say it's brought to a deal is brought to us. Say, look, I've got this particular house I want to lend on, but at the same time I'm buying another property. Then we can set the loan up against both securities and have it ready from there onwards.
Okay. If it fell under, this isn't part of Philip's question, but if it fell under a regulated mortgage contract, would that product still apply?
Okay, is this for the overdraft?
It's for the overdraft.
So the overdraft is not available on regulated. However, if we're lending to a limited company, so if it's Mr. ABC Property Lending Limited, who are going out and buying properties, and we're going to be lending to them because the facility is for the benefit of the company, but they want to use the director's home as security, and the director's home is unencumbered, because we're lending to a limited company, we secure the loan via a third-party legal charge against the property. It's not regulated.
Okay, which is
because
great.
the end client is a limited company. So it's not about getting around regulation. Regulation doesn't apply in that respect. So you can actually do it as a first charge on a residence as long as the loan is to a limited company.
Okay, final question you set was, on which properties situation would you provide a bridging loan at 0.6% per month at 70% LTV?
Sure. So this is the new rate that we have. So to qualify for that, as I mentioned at the very beginning, we're looking at loans north of 300,000 for us to do to be worth for us to do the lower rate. Otherwise, you don't earn any money. So north of 300,000. A standard property, for example, great example, a deal I'm looking at today. Someone's buying a property in Luton, a semi-detached property, with which the price I think is 550,000. We're doing a 300, and I'll tell you actually what we're doing. The loan, we're doing 385,000 of that at 70%. That is 70% loan to value at 0.6%.
Okay.
So a standard residential property in an area which has a good sales record. So let's say if it needed to be put on the market to get our money back, it will sell very, very quickly. That's the kind of situation I would say where we can get that rate.
Okay, tremendous. From our point of view, we find ABC to be, two things about them. First of all, Simon mentioned the directors, and I'm not sure, is Brian your CEO or managing director or chairman?
Brian is the big boss.
Right, he's the big boss. He's the main shareholder. I've met, obviously over the years, I've met plenty of people within lenders. Some aren't fit for purpose, but Brian probably is in the top 3 people that I've ever met in this industry, as far as industry knowledge, as far as expertise, and as far as being approachable as well. Lovely guy, but by Christ, does he know his stuff? He really, really does. Yeah. Quite amazing. I was absolutely blown away the very first time I met him, purely because of what he knew. So that's great to have. How old is he now?
82.
82, right, blimey,
yeah,
okay.
I say, and he's sharper than most of us put together.
Yeah, he's certainly sharper than me. I bet he wouldn't turn his sound off on his laptop. So there you go. Right, okay, we haven't got any more questions. We are 10 minutes ahead of time, which is great. I think we're going to be setting a new world record on one of our mortgage shows this time round. So, Simon, thank you very, very much indeed. Great presentation. Thanks for the content. Terrific. So, next speaker is Josh Knight from Octane Capital. There's a picture of Josh. I know I hasn't put any COVID, mate. You should have received this morning, which is their very colourful buy-to-let product guide. With a very, very colourful shirt as well. Like it. Can you hear us, Josh?
I can. Can you hear me?
Yeah, marvellous. Okay, so you should all receive this morning. One of you, my apologies, you actually registered at 9:59 this morning, and I didn't see the registration, so I only sent all the attachments about 15 minutes ago. So my apologies, it came over late. It's just that I literally started as you registered, so you should now have that. Okay, so a little bit about Josh. He joined Octane in February 2018 from Mariana Capital, where he was head of sales. Josh has over 10 years experience in managing intermediary relationships across private equity and property finance during his time at GMAC, RFC, Octopus Investments, Mariana Capital, and now Octane. Josh has a real passion for property finance, having been exposed to startup, packager and lending businesses from a young age. He enjoys the challenges that the specialist property market presents and likes to work on difficult scenarios. His interest, in fact, still amazes me that anyone can do this. But in May 2020, Josh completed 5 marathons, and that's actually the running, not an old Snickers bar, in 7 days, and raised over £4.5 grand for NHS charities together to support NHS workers and volunteers on the front line of the coronavirus pandemic. Well done, Josh. As I always say every time you do one of these, because Josh is a regular contributor to our shows. But that is absolutely amazing feat, really is. So well done, Josh. It's over to you. I think the next slide is all yours. I'll see you in about 20 minutes. We're still way ahead of time, which is good. So over to you.
Thank you, Tony. Hello, everybody. Really appreciate the opportunity to talk to you all today. So my name's Josh. I'm the BDM at Octane that looks after the relationship with Tony and his team. Anyone that doesn't know anything about us as a business, we are a specialist unregulated lender. We offer short-term finance and specialist buy-to-let. We've been doing it for about 4 years since we launched. But in that 4-year timescale, we've actually lent more than £1 billion. This slide is slightly out of date. We hit that £1 billion mark a couple of weeks ago. So we are growing and lending pretty aggressively. And one of the main reasons that we have enjoyed that success is the launch and the success of the product that I'm here to talk about today, our specialist buy-to-let product. Since launch, we also won Bridging Lender of the Year 2019 and 2020 at both the Moneyfacts and the Bridging and Commercial Awards, which is nice to recognise the success of our short-term lending business. But as I say, we're here to talk about buy-to-let. There are 2 reasons people use our buy-to-let product, and sometimes it's both, but either it's one or the other in some cases. The first is we don't stress test. So unlike pretty much every other lender in the buy-to-let market who need 125 or 140% rental cover, we don't. We need 100% rental cover at our pay rate, and our cheapest pay rate is 3.99%. So the product of that is that we can often lend more than other lenders. So whether it's a portfolio refinance and the borrower just wants to maximize leverage, but they're worried about rental coverage, or whether it's a new build flat in London that's got a low yield, either or, often the no stress testing approach means that we can deliver more than other lenders. And the difference in loan to value sometimes can be 10 or 15%. And I'll give you some examples in just a few slides' time. But the main reason is that one on the right. We're not a mainstream lender, we're not a bank, and we don't act like one. So we have a broad criteria, and we are here to help you with complex buy-to-let cases. And that goes for difficult borrowers as well as difficult property scenarios. And again, lots of examples to come. Before we go into that though, you'll have been sent the product guide, which has everything you need to know about our rates and our criteria. And I'm not going to go through it in loads of detail because it'll bore the life out of you. I'll just bring out the kind of salient points. We lend in mainland England only. We lend on residential and semi-commercial property, and our minimum loan is £150,000. Most of our products have a 5-year term, a fixed 5-year term with no ERCs in the final 2 years. So you can exit without penalty in the final 2 years. Our cheapest rate is 4.99%, of which we defer 1% per year of the interest rate, bringing the pay rate down to 3.99%. And we only need 100% rental cover at that 3.99% pay rate. No stress testing involved. And I promise you will get bored of hearing me say the phrase, we don't stress test. So I just warn you now because it comes out a lot. And what you find with our products is that that's our cheapest rate. And as the case becomes more complicated, the rate goes up. But that's the starting point. So what kind of cases can we help you with? Okay, sorry, I'll come on to that in just a sec. I wouldn't worry too much here about these 2 products because very, very rarely do they ever come into play. 99% of your cases will fit in either wave 1, wave 2, or wave 3. Each of the products has a 5-year term, with no ERCs in the final 2 years. So as you can see, the early repayment charges tail off and fall away completely in the final 2 years. Each of these products is structured in exactly the same way: 4.99, 5.49, 5.99, but always with 1% per year deferred, and a pay rate which we only need 100% rental cover at. A lot of people ask, oh yes, I was just about to answer that question, Philip. The 1% deferred is just added to the loan. So if you stayed in for the full 5 years, your loan balance would have grown by 5%. It's non-compounded, so it's just 1% of the gross loan times the number of years that you have the loan for. Obviously, some borrowers exit after year 3 because there's no ERC after that point. And in that case, there would only be 3% of deferred interest added to the loan. The benefit of doing it in that way is twofold. One, it allows us to stress test at the pay rate, only 100% rental cover needed. But two, it also lowers the monthly payment, which makes it just more serviceable for the borrower. It makes it a bit more manageable. And it allows them to use that cash flow that they otherwise would have been using for interest payments to do something else with. So this is, I think, the most important slide of the presentation. And what I hope is that if you come across any of these cases, you get in touch with, Tony and his team, and you have Octane in your mind. On the left, you've got borrower type that we lend to. The first is quite simple. If you've got a borrower that needs 70 or 75% and nothing else will do, and you're not getting that level with other lenders because of rental coverage, it's kind of like a no-brainer to think of Octane, because 100% rental cover at 399 often means we can deliver higher loans. What's next? Foreign nationals and expats. This is a big area of business for us. We lend to foreign nationals and expats, regardless of where they live, regardless of their nationality, and crucially, regardless of whether they have any UK property at all. They don't have to have any UK experience or any footprint in the country. It can be their first property purchase. They don't even have to have a UK bank account at the time we start an application. So that's a big area for us, as is first-time buyers and first-time landlords that live in the UK. So borrowers that don't own their main residence, or perhaps they do own their main residence, but they don't own any investment properties. We also lend to borrowers with bad credit, and it can get, it can be bad. We can talk about ex-bankrupt borrowers with missed mortgage payments. They can be catered for. Borrowers with low income or no income, so we don't have any minimum income requirement whatsoever, and also even stuff like offshore companies and trusts, although that we don't come across them too often. On the right, you've got property type. The first is very simple, low yielding property. We do a lot of new build London flats for that reason. The rental cover is an issue with most lenders, and it isn't with us because we don't stress test. We also lend on semi-commercial property. It has to be no more than 30% commercial by value, but one shop with flats above is usually fine. We also lend on residential above commercial. So if you've got a flat above a commercial premises, that's fine. And we don't have any rules around what kind of commercial premises it has to be. It can be a food outlet, a gambling shop, a takeaway, a pub. All of these things are fine. HMOs is a huge area for us. We lend on HMOs of up to 24 rooms. And we lend on multi-unit freehold blocks of up to 30 units. So we lend on the entire block. And finally, we also lend on ex-council properties and holiday lets. There's a couple more in there that I haven't mentioned, which are short leases. Our minimum lease term is 30 years. So that, very short leases is fine. And the second is planning irregularities. We often do quite a few HMO deals where the property doesn't have planning permission to be configured as an HMO. And there's a few different ways that we can structure those deals, and I've got an example that I'll come on to in just a sec. So this is my favourite case study, and the reason is because this deal came through Tony and his team, and it came out of one of these presentations that we're doing right now. And I think it's the best example that we have of why not stress testing can be so useful for brokers. So this deal was a refinance of a first floor flat in this pictured block here, worth £2 million, and our borrower needed 65% loan to value in order to clear the current debt. Really experienced borrower, high net worth, lots of properties in the background, so there's nothing quirky there. The only quirk to this deal was that the freeholder of the block had sold the airspace to a developer who were building 2 additional floors on the property. As a result of that, our borrower had to offer his tenant a reduced level of rent to compensate him for the disturbance that the building work would cause. So as a result, on a £2 million property, the level of rent being achieved was very low, £57,600 per year. So Tony and his team correctly identified that it would be difficult to find a lender to get to 65% loan to value on such a low yield, especially for a higher rate taxpayer. So we did the deal at 65%. We could get there comfortably because we don't stress test. So 499 was the rate, 3.99 was the pay rate. We only need 100% rental cover at 3.99, which meant 65% was very comfortable. 5-year term with no ERCs in the final 2 years. That was really useful for this client because the building work would have been finished by year 3, and he could have bumped the rent up and then taken it elsewhere and refinanced in that final 2 years. This is interesting though. If you look at that, I haven't put the name of the lender, but this is a real life lender that was in the market at the time. 4.25% was their rate, and 140% rental cover was their ICR requirement. And as a result of that, the maximum that they could lend in this scenario was 48% loan to value. And if you run the same process with our no stress testing approach, our maximum loan to value would have been 72%. Now, obviously, we didn't need to lend at 72%, but you can see the difference in loan to value between somebody that does and doesn't stress test. It can be massive. And for a borrower like this, the deal only works at 65% loan to value. It doesn't work anything less than that. He didn't have cash to put into the deal. So that can be the difference between the case working or not working. Hopefully that will make sense. This is we're moving up the complicated scale now, and this is a really kind of common scenario that we see. We've got a Chinese national living in China. In this case, the borrower did own one other UK property, but remember, even if they didn't, we would still lend. So we do lend to foreign nationals with no UK property whatsoever. But in this case, they did own one. New build flat in Battersea, £710,640 was the purchase price, with a rental income of 25,480. So quite a low yield, which is useful for us. What you'll notice here is that we've moved up the rate scale. It's not a UK borrower anymore, it's a foreign national borrower, so the rate's been nudged up, but everything else remains the same. The rate is 5.49%. The pay rate that the monthly payment is based on is a 4.49% rate, and we only need 100% rental cover at the pay rate, no stress testing. In this case, we also lent at 65% loan to value. I haven't mentioned this yet, by the way, but we do lend up to 75% loan to value. So it's just a coincidence that He's there at 65. 5-year term, no ERCs in the final 2 years. And again, this is just to give you an example of where other lenders were. And these are, when the case completed, I asked the broker to show me the terms that he had attained from other lenders. And these were the genuine next 2 best options that he found. Lender 1 was at 4.39% with 140% rental cover. Lender 2 were at 5.29% with 125% rental cover. And the result is that they could lend 57 or 54% loan to value respectively. With no stress testing, we could have lent up to 79% loan to value. Now, we don't lend to that level, but it just shows you that we aren't restricted by a stringent ICR requirement. We can kind of often just lend freely at whatever loan to value we feel comfortable with, without being restricted in the same way as most lenders. And now we've moved one step up the risk and the complexity scale. This is really a very complicated case, but I put it in there to give you an idea of just how complicated a deal can be, and we would still potentially have appetite. Here we've got a UK borrower, but they live in rented accommodation with their family, so they don't own any UK property whatsoever. They're a first-time buyer and a first-time landlord. Now, the property that they've decided to purchase was a 9-bedroom HMO in Northampton. To make matters more complicated, the property had no planning permission to be configured as an HMO. It just had planning to be a house. And even more, to make it even more complicated, one of the 9 rooms had a protected tenant inside, which meant our valuer wasn't allowed access to that particular room. So you've got a whole host of different issues here. So how did we get around them? Well, firstly, we lend to first-time buyers, first-time landlords. We're very comfortable lending to that type of borrower, so that point's fine. It's a large HMO, so it's not your usual first-time purchase, but we got comfortable because there was a managing agent lined up to manage the property on the borrower's behalf. Planning permission. The property had been let as an HMO for a large number of years, so we got comfortable with established use. There are a couple of other ways around it though, so even if it hadn't had a long established use, we could have still found a way of getting that done. The point about the protected tenant, we just had to take a view on that. We weren't allowed inside, so we just had to take a kind of realistic estimation of what the property was worth in light of that point. And again, you'll have noticed that we've taken another step up the rate scale. You won't really see rates from us go higher than this. So this is really the cap for us. 5.99% with 1% deferred, giving a pay rate of 4.99%. Monthly payment based on the pay rate, no stress testing, 5-year term with no ERCs in the final 2 years of the term. Hopefully that all makes sense. Appreciate I've rattled through that. Oh, good question from Philip. How long did it take to underwrite? Well, this case took about 6 or 7 weeks to complete, which is actually slightly longer than average for us. I'm glad you asked the question though, because completion timeframes is a really important point to note. Our average time to complete a buy-to-let loan from start to finish is between 2 and 6 weeks. A lot of our deals complete within 4 weeks. Because we're a bridging lender that also does buy-to-let, all of our processes are geared towards bridging completion timeframes. So quite often we get an inquiry in from a broker that plans to do a bridge and then refinance onto a buy-to-let. And we say, look, cut out the bridge and just take the buy-to-let straight to us, because we'll likely complete in the same time frame as your bridging lender would have done. And finally, because I can see Tony's joined the call, so it's probably my cue to stop talking, but as well as buy-to-let, we also do these three other things: bridging, developer exits, and residential refurbishments. We're also a short-term lender. So if you do have a short-term funding requirement, then we can help with those too. There we go.
Josh, brilliant as always. Just what was I about to mention? I was about to mention something actually just on... yes, I was actually, you gave your case studies. I'd give everyone, just give an example of the sort of things that Octane will do. I mean, I'm giving an example later on when I do my final part of today regarding the client that completed very recently, what was it, about a month, 2 months ago, whatever it was, where the introducer earned 32.5 grand from the deal. And then he gave us a name and telephone number. Literally, that's all he gave us. And that was an Octane deal. But we've got a deal going through at the moment. It's just been offered, I understand. We've got 4 borrowers who are looking to raise as much as possible because family developers, they wanted to capital raise as much as they possibly could, unencumbered property. So that was the remit. The property is actually a property with an annex, has 2 kitchens, and also has holiday let usage. So it's not ticking a lot of boxes for many lenders out there. And that's going through at 3.99% with 1% deferred. And we're probably there or thereabouts at the stress testing wise, it was getting nowhere near 70% with any other lender that we was approaching. So the remit from the client was to capital raise as much as possible. And it's exactly what we're doing. And because of that, because we're able to do that, we're now doing another 2 through another lender. And we're shortly be going back to Octane with another 8 properties, I believe it is, that are sitting within a trust. So all good. That's only complicated because one of the trustees recently died a week ago. So that, unfortunately, so that's obviously bits to be sorted out. I'm going to go to the questions, but there's also another couple of things I'm going to say about Octane as well, because I think they're both incredibly important. But we'll go to the questions first. And Josh, these are ones you set yourself. So I think you've answered the first one. And the 4th one you've actually mentioned about 10 times, but I'm going to ask it anyway. So can you lend to those with adverse credit?
Yeah, adverse credit from minor blips all the way up to really, really hairy credit scenarios we can look at. So if it's just like a utility bill that they forgot to pay, then we normally don't even class that as adverse. But missed mortgage payments, default CCJs, they're all fine with us.
Okay. Do you have a minimum income requirement?
Only on our cheapest product, and that's the 499399. And that minimum income is £30,000, and it includes all forms of income, including property income. But for every other product, there's no minimum income at all. So we don't need the borrower to be earning anything, and we would still lend. Okay.
Can you lend to foreign nationals who are also first-time landlords?
Yeah, I think I stressed that point a lot.
But yeah, I just want to make sure I couldn't remember. So.
Yeah, no need for a foreign national to own any UK property. And I would say that 80% plus of the foreign national buy-to-let deals we do are for people buying their first property in the UK.
Okay, a final question that you set yourself. Do you stress the background portfolio?
No, that's a big point around portfolio refinances. All of the rules that regulated buy-to-let lenders are constrained by, we aren't. We won't even ask the question as to the background portfolio. We're only interested in the security properties that you give to us, and do they cover 100% of our pay rate? That's all we care about.
Okay. The 2 things I was going to mention, this is our experience of Octane. I mean, they're not a huge lender by way of like staff numbers. The 3 guys that set it up have got donkey's years of experience. They were the people behind Octopus, which originally I think was called Drawbridge Finance back in the day, then became Dragonfly, and then Octopus Investments. So they've done all this before. The fact they've now got to £1 billion and length of time they've actually been lending is, I think, an amazing feat. But it's the staff as well. I mean, as an example, we know quite a few of the staff because they've been in the industry for quite some time. Worked for one was actually our underwriter at a lender back in I think 2008. But one of their staff is also a qualified surveyor. So the big case we had go through where we paid the broker over 30 grand. As we all know at the moment, the big problem we've got on cases is surveys. We've all got a horror story, and I've probably got more horror stories in the last year than any year previously, because some of the stuff we're seeing coming back is just ridiculous. But because this on this particular case, the surveyor really was being absolutely ridiculous. The Octane member of staff, who is a qualified surveyor, could see through that. And because he could see through it, it was, if a client's getting three grand a month in rent, but the surveyor says that it's only actually 2 grand, but he's been receiving that rent of 3 grand for the last 8 years. It's a stupid thing. It's just a surveyor trying to protect his PI cover more or anything else. So it's not just someone who's sitting there. I do know of lenders who've actually got surveyors who work within there who seem to be business prevention officers sometimes. With Octane, it certainly isn't. It's actually completely the opposite. I think they probably realise that most surveyors out there are absolutely should not be probably in the industry at all. Should probably go and retire. But that's why I think that guy. That's why it's so handy to have that guy actually in place. And the other thing I'm going to say is, and I did actually comment on this last year, because obviously during like the lockdown last year, things were very difficult for lenders. But their post-offer service is by far the best I've seen in many, many years. We all know what surveyors are like. Lenders have the solicitors are like. Lenders have their own solicitor. The client has their own solicitor. And their job most of the time is just to delay things as much as possible. So, of course, the clock is ticking. Every time they send an email, it's another 60, 70 quid they can charge. Well, Octane staff don't like that. We don't like it either. And we're on to the solicitors, but Octane staff especially are then straight onto solicitors. If something crops up and they think, you know what, we're not really bothered about that, then they deal with it. They don't let the solicitors deal with it between them. They will actually cover it. And the offer to completion times are absolutely amazing. They really are amazing. So if you haven't used them before, seriously, look at all your cases you've declined in the last 6 months, that your buy-to-let cases in the last 6 months, your semi-commercial cases in the last 6 months that you've declined because of affordability, and give us a call, because you will earn some money out of it, and there are substantial amounts. There was one guy last year, one of our very first roadshows, guy attended, had a couple of cases that he'd not been able to do anything on, one of which was actually one of the ones that Josh mentioned as a case study, the very first one. That guy gave us 2 cases. Those 2 cases, both have now gone through, both with Octane. And guess what? He earned an absolute fortune out of those. I think his earnings are over 25 grand just on those 2 cases. And ever since, he's now given me another 20 cases. So it's, for us, it's absolutely fantastic, because he'd never heard of Octane, because they're not widely out there. They win award after award, but they're not widely known because they don't appear on the sourcing systems. That's one thing I'll say. But we actually have our own software which does source Octane's products, and we can quote within seconds. So we've no more questions, Josh. It's 11:45 almost, so we are still 10 minutes ahead of schedule, which is fabulous. It's now down to me on the very final leg of this a little bit later on to ruin things for everybody. But Josh, great stuff. Thank you very much. I will now go to our final speaker is Jonathan Prince from Allica Bank. I don't think he's put any weight on over COVID either. It's just me, unfortunately, this time. And you should have received this by email from us today and this morning. Again, if you haven't received these, just let us know. If they're not in your inbox, not in your spam, they're not sure what's happened, let us know and we'll find an alternative route to get these to you. And he's still not in the room. No, he's not. So Jonathan has been working in commercial finance for the last 9 years, all of which have been spent with small challenger banks. He has largely worked in credit functions, giving him a strong understanding of business risk, and moved into relationship management at the start of 2020. I'm not going to say his part really slowly because he's still not in the room. Interesting fact, Jonathan has moved house. I actually believe that I should actually say 27 times, because the last time he presented it, he was about to move again. But he's moved house, when he wrote this, 26 times in 31 years. Now, I originally thought maybe he was, under witness protection or something, maybe, but it's not the case at all. Apparently, I believe from memory, his family were in the forces, so they used to move around a lot. So that's the reason why. And he's still not in the room. So if you just bear with me one moment, everyone, I'm going to try and find out from my team who are next door exactly where he's got to. So just bear with me 1 second. Technology, eh? I just love it. Hi, do you know where Jonathan is? You're phoning him now. Okay. My team are on to him, trying to get hold of him. So, so anytime at all. Just a little bit about Allica. We came across Allica pretty much at the start of lockdown last year, when all the lenders that we were giving our commercial business to, and it's pretty much mostly commercial that we give them, just completely pulled out of the market for obvious reasons. But they just pulled out across the board, which I didn't think was right, because not all businesses were affected by COVID. Some have actually thrived through COVID. So we had Allica, gave them a couple of cases as a test, went incredibly well. Absolutely amazed by what they were doing, and that's moved on from strength to strength. They're now doing stuff. They've recently had a product, I think it was sitting at around, I think, was it 3.5 that was for owner occupier that's just been withdrawn. But we're hoping they're going to come out with some new limited edition products very, very soon. But they proved to be absolutely invaluable for us over the last, what is it now, 16 odd months. Absolutely brilliant. And we've still not got him. This has never happened before on any of our shows that the presenter's gone AWOL. So, no, still not there. Right, okay. So what we might do, and this is an absolute first for me, it's if we can't find him, oh, he's there, right? He's now in the room, so he should be appearing any second. I was about to do his presentation. So, and there he is. Jonathan, we got you. Can you hear us?
Hi, Tony. Yeah, I can indeed. Can you hear me?
Yeah, absolutely perfectly. Right. So I've already done your introduction. I was very nice about it. I didn't slag you off in any way whatsoever, I promise. I'm going to actually, your slide's the next one. I'll see you in about 20 odd minutes. So you crack on. I'll see you shortly.
Fantastic. Great. Thanks, Tony. And thanks for everyone for having me. I've just noticed there that says April 2021. So apologies for that, first of all. But we'll get cracking straight into it. So what I'm going to talk to you today about is a little bit about us as a bank, the products that we offer and the processes to apply for those. Talk a little bit through any future developments that we've got on at the moment, and there'll be some time for any questions at the end. So Allica Bank have been around in the market for just under 2 years now, and we launched with the focus really of providing a true alternative lender for SMEs. So we launched with a commercial mortgage offering, which has been there, like I say, just under 2 years. And around about a year ago, we launched our asset finance product as well. I work on the commercial mortgage side of the business, so that's what I'm going to be talking through. And we've got lots of developments underway to try and provide, like I say, that full service offering to SMEs. So this image here just gives a little bit of an overview of where we're hoping the bank will be in 18 months, 24 months time. And as you can see, we're going to be looking to provide business current accounts, overdrafts, card facilities, and then once we've got that core banking offering in place, we can then start looking at things like invoice finance and invoice discounting, cash flow lending, and truly become that real alternative for the trading SMEs out there. So our proposition to the broker market is built around 3 core values. Straightforward, we look to try and be as honest with you as possible, right from the outset, all the way through to conclusion of a case, and try and keep that process as simple as possible. Integrity is about following through on our promises and, not hearing one thing from your BDM and then another thing from the underwriter and then another thing from the completions team. It's that joined up message all the way through the process. And collaboration is really about working with you and your clients rather than against you to look to deliver that service that you expect your clients to receive. So I'll skim over the products quickly now as well. So our offering is a pretty standard mortgage product available to owner-occupiers and commercial investors, and that's both on semi-commercial and full commercial property. We don't do anything in the pure residential world. Our loan sizes are from 150,000 up to £5 million, and that's a per loan and per customer limit. Loan to values I'll come on to shortly. They vary based on asset type. Mortgage term is anywhere between 5 and 25 years. And I think one thing that's really important for us to call out is that is a committed term. So it's not a 3 or 5 year commitment over a 20 or 25 year profile. That is a true commitment to your customer over that term. So if they take a 25 year mortgage, they have got that facility for 25 years. Everything we do is a variable rate over Bank of England base rate. We don't have our own internal base rate that's, 0.5%, 0.75%. We use actual Bank of England base. So at the moment, that is 0.1%. And another thing that sets us apart in the commercial world is our approach to security. So the only thing we are taking as standard on every single case is a first legal charge over the property. Debentures, personal guarantees, corporate guarantees, they're all very much case by case. It is an additional security that's taken when we feel we need to add that. It's not something that's just slapped onto every case where we're lending to a limited company. ERCs are in place, 3% for the first 5 years. After the 5-year period, customers are free to repay that facility without any charges. And we do allow 10% of the outstanding balance each year to be repaid without penalty. So onto the specifics of each product, starting at the top here with our owner-occupied product. That is a capital and interest offering, but we do allow the first 2 years to be on an interest-only basis. So what that would look like on a maximum would be 2 years interest only, followed by a 23-year amortization. Again, that's fully committed. There's no break at the 2 years or anything like that. It's just an offering for our owner occupiers at the start. Typical margin range is 4.55 to 5.85 plus base rate. The way that margin range is calculated comes down to 2 things. The first is the loan to value we're being asked to lend. And the second is the credit score of the borrower. So for a limited company, that would be their Experian business score, and for individuals, it would be their Experian personal score. And in essence, what that means is the stronger clients, the better profile clients benefit from our stronger rates on an owner-occupied basis. And for our debt service cover, we look for 130% cover, and that is using adjusted EBITDA, which is essentially operating profit plus any add backs such as rent being replaced, and minus things such as other lender repayments and dividends or drawings taken out of the business. There's no stress testing on that, and it is a straight 130%. Onto the investment product. This is either a fully amortizing product or an interest only. So amortizing is available up to 25 years, and the interest only is between 5 and 10 years. That is a one or the other. It's not a case of being able to do like a 5-year interest only followed by an amortization. That would be a refinance required at the end of interest only term. The margin ranges here are much more specific. Quite often we find with property investment, you'll have an SPV that's just been incorporated, and the risk score isn't necessarily reflective of the borrower. So we've taken the risk-based pricing out of our investment products, and it is a pure LTV differential on the commercial. So under 60% LTV is 5.2 plus base, and over 60% it is 5.75 plus base. And on the semi-commercial, we've decided to take a different approach to the rest of the market here, in that we offer different pricing depending on how much of that property is residential versus commercial. The reason being, we as a bank get different capital treatment for properties which are more residential, and so we pass that on through our margin ranges. So if you've got a property that is less than 50% residential by floor space, the pricing on that is 4.95% plus base up to 60% LTV, or 5.55% over that. And if the property is more than 50% residential, that is our lowest pricing on our investment products. So to the best of my knowledge, the 4.5% up to 60% LTV is actually a market leading rate at the moment. And likewise, above 60%, the 4.8, I believe, is the best rate in the market. It's constantly changing, so don't quote me on that. But certainly at the time of launch, they were the better 2 products out Again, from a debt service cover perspective, we use gross rent and we look for 135% cover. Again, no stress testing, no net rent deductions. That is applied to all loans regardless of the repayment profile. So if we're doing a 10-year interest only loan, we still look for that cover over a 25-year amortizing loan, just to make sure that we can get that refinanced at the end of the term. So onto the property types, you'll see here a list of the sort of standard property types that we offer facilities against. And our appetites vary between 60 and 70% depending on the asset itself. So a lot of the lower LTVs available are sectors where we've seen particularly high impact from things such as Brexit, COVID, and those property values are fluctuating a lot more than perhaps some less affected industries. So at the top of that list, we've got professional practices, holiday lets, and anything of that industrial warehouse nature. That's just a straightforward 70% on those assets. For offices and retail, our appetite very much depends on a series of factors, including the quality of that property, the tenant that's in place if it's an investment, or the strength of the business on an owner-occupier basis, and the location. And really what we're looking at is, for a high demand property, we're comfortable at that 70% region. For anything that's perhaps secondary or tertiary, we're going to be closer to 60 or 65%, depending on the asset. Likewise, garages and vehicle showrooms and food outlets, that's cafes, restaurants, takeaways, they're in our 65% banding, and student accommodation at 60%. And it's worth calling out that is purpose-built student accommodation rather than HMOs or a house that just happens to be let to 2 or 3 students. The property types at the bottom are those which include inherent goodwill in the property value. So where you've got a convenience store or a pub, something like that, the building obviously has a value just as a bricks and mortar building, but the business enhances that value just by nature of the reputation and the turnover that's attributed to it. And on those property types, we do lend against that goodwill value. So the bands that you see here are maximums, and we look at the lower of. So for example, a convenience store, we would be at the lower of 65% of market value or 80% of vacant possession value. And that follows through for all of those different property types. And I think whilst it's lovely to cover what we do lend on, it's also worth touching on the sectors that we don't have appetite for. What you see here is the usual things such as arms and weapons, adult entertainment, gambling, those sorts of reputational risk businesses. And as it stands at the moment, we don't lend in the care sector, we don't lend on religious buildings or nightclubs, and we don't lend on those sort of caravan parks, lodge parks, those sorts of things. But anything that sort of falls through the cracks of the clearly defined property areas, by all means, get in touch with your contact at specialist, and they'll more than happily speak to us and advise on what we can or can't do. And then I thought it'd be useful to try and bring some of these products to life just by talking you through a few case studies of real loans that we've drawn down and completed on over the last few months. So this first one was a purchase of a trading pub in Devon. There was 2 applicants that had managed to run the pub for a number of years, decided to step back from the business and let it out. The lack of investment experience here was really mitigated by the very low loan to value, and we were able to offer them a facility at 35%, 5.5% plus base rate. This second transaction was an applicant that was looking to purchase the freehold of the building that he'd been trading from for a number of years. The ownership of the business and the property were actually going to be different, so we treated this as an investment rather than an owner-occupied transaction. And despite the business having been closed for a number of months over the last year and a half due to restrictions, we could see that there was a strong and profitable business in there in normal times. And we lent them 60% of the property value, 5.65 above base rate. This third one was a very straightforward commercial investment proposition, experienced commercial landlord looking to add another property to his portfolio. We were happy to lend here at 70% of the property value with no additional security taken. Nice, easy transaction with a good tenant. The fourth transaction is a case where the applicants were actually looking to sell their trading business in the medical supplies industry, but retain the office which it traded from and let it out to the company that they were selling. They were, again, first-time investors, but their knowledge of the unit and the business were obviously very strong. So we were able to lend to them quite comfortably, based on the strength of the accounts that we had the benefit of being able to see because they were the current controllers. We did take a personal guarantee on this case for £100,000, which was just under 25% of the loan value. And that was really just to mitigate their lack of experience as property investors. The fifth case study, I was actually down here yesterday visiting the customer. It was a guy who owns a very, very successful security and close protection business. And he was looking to diversify out into a different market. And one of the things he offers through a security company is residential training courses. And he thought, well, you know, why pay somebody else to put my students up when I can put them in my own hotel and make a little bit of extra income? So he purchased a hotel and a cocktail bar on the south coast. And what we did ask is that he brought in some individuals with experience in those sectors into the companies to help him manage them. So a 10% shareholding was given to the general manager of the hotel and the chap that was running the bar. And this was a really impressive transaction. So start to finish, we completed in 11 weeks. And that was with the case at the time having to go to our credit committee. So, you know, really we were quite swift through that one. This sixth one was a purchase of a small pub. Again, very experienced hospitality professional, run a number of pubs across the UK, and they were looking to operate the bar element themselves, but let the B&B part of the property out to a third-party operator. This one was actually a complete startup. So the pub had been closed for a few years, and our applicant was looking to restore it to former glory. This one, whilst we wouldn't normally lend on projections, because we could see the strength of the group, the guy has a strong track record of taking these closed assets and bringing them up to successful trade. That gave us a lot more confidence in putting a facility out to them. And that one drew down about 8 weeks ago, I believe. So one of our more recent ones. And this final case study is one of our sort of more quirky loans. This was an owner-occupier that was looking to purchase an industrial estate to expand their business into, but they were only actually intending on operating from around about 15% of the overall site. No investment experience, and actually if you looked at it as an investment case or an owner-occupier case, it wouldn't have got there on trading profits or the rent. But actually when you combined the two, there was really strong serviceability across the both income streams. And the chap was very impressive. A lot of the tenants had been in there for 10, 15, 20 years and therefore quite a stable income base. And that allowed us to get comfortable with that transaction. So that's it for the case studies. If you've got any inquiries on specific cases or any questions on anything I've talked through today, by all means get in touch with the team at Specialist and they'll be happy to answer any questions on my behalf.
Jonathan, thank you very much. I have to discuss a case with you actually this afternoon. I went and saw a client yesterday. The good news is it's 8% loan to value.
Oh, wow.
Yeah, so
that's unusual.
Yeah, very unusual, incredibly unusual. Yeah, it's a very unusual case, but I'll discuss that with you later. There's been no questions from the delegates, so I'm going to just go through the ones that you've set yourself. So, are you an online only bank?
We're not, no. We have a team of relationship managers across the country. So we actually have 3 teams now. We have the asset finance broker team, the commercial mortgage broker team, which I myself am part of, and we actually have a network of direct customer relationship managers now as well. Currently at around 5 in the direct customer market, but the goal is to expand that into 20, 30, 40 over the coming months and years.
Okay. How do you treat OpCo, PropCo scenarios?
This is one that I actually need to update my presentation to make sure I cover. It's a question we get a lot. Basically, we treat OpCo, PropCo as owner occupied. We look through from the property company into the trading business to assess their stability and financials. And we do treat them as owner occupiers, which quite often means that they're benefiting from better rates and improved terms on the facilities.
Okay. No, still nothing from the delegates. So, what changes, enhancements are we looking at are you looking at making to the product over the coming months?
We're actually starting to slow down slightly on the enhancement. So the next big one is we're looking at an expansion into Scotland. So as it stands at the moment, we only lend in England and Wales. We are hoping, I won't say the end of this month because that's too short a timescale to set ourselves, but certainly in the next 6 to 8 weeks, I would expect us to start lending on property in Scotland. And it's also worth covering at the moment, we're running a promotion for our owner occupiers, where if they can demonstrate more than 2 times repayment cover, and they're looking for 60% loan to value or less, we're actually offering a 3.5% plus base product. That is limited time. It only runs to the end of this month, or to £50 million, whichever happens first. But that's a true sort of high street rate that's not often available from challengers. So definitely worth mentioning. Okay.
We've got no questions from delegates. So, and we're now 15 minutes ahead of schedule. This is unheard of. Wow. We're like the triathlon of the finance industry. Yeah, there or thereabouts. Jonathan, thank you very much. Absolutely great. Obviously, delegates, this is a lender at the moment that is doing stuff that others really aren't doing. You probably, if you are involved in the commercial side of things, and you're aware how many lenders pulled out, certainly of the owner-occupied market, there is business to be done. Well, the proof of that is quite simply that my commercial team, and that's the commercial team that deals purely with commercial and semi-commercial property, is by far the busiest of all my teams at the moment. Purely because I think there was a real sort of like everyone put their plans on hold last year, and of course, what's happened? All of a sudden, everybody wants to borrow money. So, yes. Unfortunately, a lot of them are expecting to be getting sort of like high street rates, but the high street seem to dip their toe in one day, then a day later, their toes come back out again because they don't like the temperature. Yeah. But Allica certainly have been absolutely fabulous for us. We've even had offers. This was during lockdown, by the way. We had an offer a little while back, which is hopefully going to be taken up fairly soon for a restaurant. Now, at the time, I believe restaurants were closed when that was offered. Yeah, so there you go. I mean, really great addition to our portfolio of lenders. So if you've got anything on your desk, you know what to do. Just give us a call. Jonathan, thank you very much. We'll now crack on with the final part.